Okay, FBD has asked me to give an economic and investment update for its clients. The global economic environment is undoubtedly still quite difficult, but for the first time in quite some time we're at last starting to see some green shoots of recovery. The US economy is clearly starting to stabilise, albeit at low levels of activity, and even in continental Europe, where there has been very significant downward momentum in recent times, we are starting to see some indications that things are starting to level off. So that certainly represents positive, because before we can start to talk about international economic recovery, we need to see a stabilisation, and I think we're now starting to see the first signs of that. And that's not terribly surprising, because we've seen very significant downward momentum over the last couple of years, and in response to that, global authorities have literally thrown the kitchen sink at the difficulties. Interest rates have fallen to historic lows. Governments around the world are now recapitalising their banking system. Taxes are being cut and governments are increasing spending. So there's a very strong official policy response that is now starting to work. However, I think it is important to bear in mind that this stabilisation is happening at very low levels of activity, and it is going to take quite some time for the global economy to get back into a serious growth momentum again. Over the remainder of 2009, I think we can look forward to ongoing signs of stabilisation, but really it's likely to be 2010 before we start to see strong signs of economic recovery, and really it'll be 2011 before we're back in business. From an investment perspective, that is certainly creating a more favourable background than we've seen for quite some time. International equity markets, having bottomed at very low levels around the middle of March, have rebounded very strongly since then. Basically, markets are now saying, we believe markets have fallen far enough. We believe that the global economic cycle has now started to bottom out, and that the interest rate stimulus that's being given in particular will gradually work over the next couple of years. We know from previous economic and investment cycles that investment markets typically tend to turn 6 to 9 months before the economic cycle. So that's what we're now starting to see happening. There's no doubt about it, there will still be incredible challenges over the coming months, and the recovery in equity markets is unlikely to proceed in a smooth upward trajectory. However, I think while there may be some volatility, I think over the next 12-18 months we can look forward to a stronger global equity market performance than we've seen for some time. In terms of the Irish economic momentum, the news out there in the economy is still pretty bad. The public finances are still deteriorating at a rapid pace as tax revenues fall off. Unemployment is still rising, but the labour market is always a lagging indicator, and unemployment will tend to rise even after the economic cycle has bottomed out. Consumer spending is still very weak, and consumers are justifiably very cautious at the moment. Consumers are worried about rising unemployment, about wage cuts, but more particularly they're extremely concerned about the increased tax take that's being given to the government at the moment, particularly the tax increases following the April mini budget. In terms of the export performance, Irish exporters are doing reasonably well, although exchange rate developments in international markets are still making life quite challenging and quite difficult. I think this year the Irish economy is undoubtedly going to contract by 8 to 10%, which is very significant. In 2010, it's likely that we will start to see a slowdown in the rate of deceleration, but I think it's going to be 2011 before we start to see any positive growth momentum returning to the Irish economy. The one thing that is certainly going to work in favour of the Irish economy is the likely improvement in the international economic cycle over the next couple of years, because regardless of what government does vis-a-vis taxation and spending, if the international economic background is recovering, it will undoubtedly give a boost to the Irish economy. I think the key priority for Irish policymakers at the moment should be to try and continue to improve the competitiveness of the Irish economy. 10 years ago, the German economy was in a serious mess. They set about trying to restore the competitiveness of the economy over the last decade. It worked. It has created a very positive export momentum in the German economy over the last 2 or 3 years. I think that's what we need to do in Ireland. improve the competitiveness of the economy, make the whole platform for exporters better again, and that will eventually feed through to the rest of the economy. But in general, on the ground, over the next 12 to 18 months, the Irish economic background is going to remain quite challenging. Government will be taking more taxes, unemployment will rise further, but I think we have to work through that process and make sure we set up a strong platform for domestic economic recovery in 2011. In terms of pension contributions, I certainly would believe that there is an ongoing requirement for everybody to continue to contribute strongly to their pensions, because at the end of the day, this is the greatest financial liability that the country and individuals have, and we need to continue to address it. And I don't believe we should be put off by the market performance we've seen in recent times, if not for another reason than the tax incentives for pension contributions are still very attractive. But where would one put pension contributions at the moment? I would believe that if people are still a distance away from retirement, I think investment in international equity markets would represent a sensible policy at this stage. For people who are closer to retirement, obviously going for more riskless assets such as government bonds and high yielding deposits would be the way to go. The one thing I would not advise at this juncture would be investment in property. I think globally and domestically, the property cycle is still very much in a downward momentum, which is likely to continue for the next couple of years. So I would be avoiding property as a pension investment at this juncture. So international equities are looking reasonably attractive, and for the more risk-averse individuals, government bonds and high-yielding deposits would be the way to go.